the conflict in the Middle East escalated sharply. The Strait of Hormuz was effectively closed and has been ever since. And the consequences are now flowing through every corner of the global economy.
The global outlook is under pressure after a run of shocks with growth momentum dented and price pressures reemerging across many economies.
The title of our outlook today is Under Pressure. That is not a rhetorical flourish. It is precisely where the global economy is at. For 5 years, the world economy showed remarkable resilience, absorbing a pandemic, and annual growth reached 3.4% last year. The technology sector was booming. AI-related investment was providing real momentum. And then in late February, the Gulf region is far more than an energy supplier. This slide illustrates the breadth of the exposure. Prior to the conflict, Gulf countries accounted for 26% of global oil supply and 31% of all liquefied natural gas. Global oil supply has since fallen by 13.5%. Gulf oil production is down 45%, but the disruption extends well beyond energy. Qatar alone accounts for around 35% of global helium exports. Helium being a critical input for semiconductor manufacturing, which is now under acute pressure, precisely at the moment when demand is surging from AI and digital infrastructure investment. That is, the upside and the downside risk are directly connected.
Escalation in the Middle East has tightened energy supplies and disrupted key commodity chains, pushing up fuel and industrial costs worldwide.
The energy supply shock has produced sharp increases across the board. Brent crude rose to $118 US per barrel in late April, its highest level since 2022. It has remained above $90 for nearly 3 months. Diesel and jet fuel prices are around 50% higher than before the conflict, pushing up transport, aviation, and freight costs across the global economy. But the surge in commodity prices extends well beyond energy. Prices have risen by up to 55% for a range of non-energy commodities, highlighted on this slide. That means higher costs for fertilizers, digital technologies, automotive components, and chemicals. Inflation, which had been on a clear downward path, has turned. Since February, price pressures have risen in the United States, the Euro area, South Africa, Brazil, and India. Government support measures, price caps, subsidies, tax reductions have contained some of the increase. Without them, the picture would be worse, and of course the impact will not fall evenly. Around 1/3 of OECD economies are projected to experience negative real wage growth this year. Workers in these countries will see their living standards fall, which is the human reality behind the inflation numbers in front of us. There's an important countervailing force in this picture. The technology sector, and in particular investment driven by AI, has been a significant engine of growth. Industrial production of computer and electronic products is substantially outpacing total industrial production. But as the helium and semiconductor point illustrates, this positive force is not insulated.
Near-term projections point to slower growth and higher inflation than before, leaving many households and workers facing tighter living standards.
Effective tariff rate on United States merchandise imports was around 10% in April this year, down from around 18% a year earlier. This reduction has been positive for trade and growth and is one reason underlying momentum was stronger than expected before the conflict escalated. However, uncertainty remains high. The 10 percentage point tariff introduced by the United States following the Supreme Court's ruling on the International Emergency Economic Powers Act is due to expire in late July unless Congress projection, the relatively more time-limited disruption scenario, assumes energy prices evolve broadly in line with futures markets as of 26 May, with oil averaging $92 US per barrel this year and $80 next year. We project global growth of 2.8% this year and 3.1% next year compared to 3.4% last year. That is 0.4 percentage points lower for 2026 than we projected in February before the conflict escalated. On inflation, average G20 headline inflation is projected to rise from 3.4% last year to 4% this year, or 0.9 percentage points higher than our February forecast, before easing to 3.1% in 2027.
Pour atteindre
In the United
3,1%.
States, stronger energy sector
Aux
exports
États-Unis,
will partly offset lower household
l'amplification des
purchasing
exportations
power.
du secteur de
GDP
l'énergie
growth is
compensera en
projected to
partie
slow
la baisse
from
de pouvoir d'achat des ménages.